If you live in America and Europe, Oatly is probably no stranger to you. But do you know that one of China's flagship state conglomerates is this popular oat milk brand's largest shareholder?
Oh wow.
I believe that.
Wow, that's pretty cool.
Which is the company that owns it.
A joint venture between China Resources and Belgian venture capital firm Verlinvest owns 56% of Oatly. Even after the IPO, the Chinese-Belgian entity is expected to hold a commanding 48% of the oat milk brand. So what exactly is China Resources? China Resources is a state-owned conglomerate operating in Hong Kong and mainland China, with businesses across a wide range of industries, including real estate, construction, healthcare, and finance. It was established in 1938 in Hong Kong as a financial backbone for Mao Zedong and his revolution during the Chinese Civil War. By 2020, it was the 19th largest Chinese company, with 94 billion in annual revenues. And, as a state-owned entity, it's governed by the investment unit of the State Council, Beijing's highest administrative branch. So why is China Resources backing Oatly? Oat milk, which was little known in the US until the Swedish brand appeared in American grocery stores in 2017, is now America's second most popular plant-based dairy product after almond milk. And Oatly is now making a big push into Asia, especially China, hoping young Chinese will also get hooked on oat milk. Plant-based drinks are the fastest growing beverage category, with a compound growth rate of 25% during the period from 2007 to 2016. And now let's look at Oatly. In April 2020, Starbucks announced the introduction of Oatly in all stores in mainland China. From January to April 2020, Oatly's sales on Taobao, one of China's most popular online shopping platforms, grew over 2,000%. China Resources is known for owning China's best-selling beer brand, called Snow Beer, and two high-end supermarket chains, Olay and BLT. They own, in other words, one of the most sophisticated beverage supply chains in the world, and the stores where customers buy their beverages. It's not likely to miss the opportunity to play a significant role in Oatly's China expansion. But that may be a cause for investor concern. Recently, US regulators and lawmakers have come down harder on China-affiliated firms amid rising accusations of fraud and anxieties over national security. In March, the Security and Exchange Commission said it would begin to enforce the Holding Foreign Companies Accountable Act, which could kick Chinese companies off of US stock exchanges if they don't comply with audit requirements. Meanwhile, in China, state secrecy laws prevent China-based firms from disclosing auditing information to overseas entities. Oatly, which is listed on the Nasdaq, could get delisted if China Resources refuses to hand over certain financial documents the state deems too sensitive. And of course, given the Chinese government's recent probe of Didi, the Uber of China, it's clear that Chinese companies listed in the US can face a lot of uncertainty and regulatory risk. One day, Oatly may have to choose between a crop of American investors or its Chinese benefactor.